Do not take any trades unless you see this signal forms on your chart. The signal that I'm talking about here is called the first pullback, and in this video, I'll explain how you can use it to minimize losses while increase profits for every trade that you take. So without further ado, let's get into it. So, what is the first pullback? The first pullback is a highly predictable pattern that shows up in almost every trade setup. Here's how it works. Imagine the price is in a downtrend and begins to reverse into an uptrend. As we know, it's extremely rare to see a perfect V-shaped reversal when the trend is changing. What typically happens is the price starts to reverse, makes a brief pullback first, and then continues climbing. Now, this initial pullback after the reversal is what we call the first pullback. And I'm not exaggerating when I say this pattern is everywhere on the chart. Want proof? Let's look at a couple of examples. Take a look at this Bitcoin 4-hour chart. The price was in a downtrend and reversed upwards. It then made a slight pullback first, before continuing trending higher. Here's another chart from gold, or XAU. This time, the price was initially in an uptrend. Then it began to reverse downwards, but it made a slight pullback first, before continuing downwards. Here's a chart from Apple stock. The price started off trending downwards. It then reversed upwards, made a pullback, and resumed upwards. You can find countless of examples like these on any chart. Try it out for yourself after watching this video. So, the main concept behind this strategy is to time the first pullback and aim to enter at around the end of the pullback. The key reason for this comes down to one crucial factor: risk-to-reward ratio. Let's break it down with an example. Imagine spotting a setup where the price was initially in a downtrend. Then, a strong buying pressure pushes it upwards. As a trend trader, you might see that the trend begins to shift and think about entering buy. But buying immediately at the highs of the trend isn't the best move. Why? Because there's a chance that the price could pull back. Or worse, the uptrend could fail entirely. If you enter at the highs with a tight stop loss, the pullback alone could stop you out. And if you set a wider stop loss to account for the pullback, you'll end up with a much bigger loss if the trend fails altogether. This is exactly why waiting and entering at the first pullback is almost always the better play. At a pullback, you're getting in the trade at a more favorable price, which means your stop loss can be tighter. If the price keeps dropping after the pullback, that's a signal that the uptrend is invalid anyways, so having a tight stop loss keeps your losses small. But if the trend holds and price pushes higher, you're set to make bigger profits since you've entered in at a lower price. It's a win-win condition. You'll get smaller losses on failed trades and much higher gains on successful ones. Now let's break down how to trade this strategy step by step. But real quick, I want to let you guys know that I also share trade signals completely for free. The first step of trading the strategy is knowing how to identify a trend reversal. This part is absolutely crucial. If you mess this up, the trade simply won't work. Here's how to do it. So, one of the very first things traders are taught is how to spot uptrends and downtrends. If the price is making higher highs and higher lows, it's an uptrend. If it's making lower highs and lower lows, it's a downtrend. Simple, right? But here's the thing. There's a good chance you're actually getting this wrong. Let me break it down for you with an example. Imagine a chart forming higher highs and higher lows, clearly showing an uptrend. But then, something interesting happens. The price starts heading down and breaks a previous low. Here's where I see most traders make mistakes. When this low is broken, many assume the trend has reversed, thinking we are now in a downtrend. But what if I told you that this chart is still fundamentally bullish? Sure, the price broke a low, but this low isn't actually a valid one. Why? Because it didn't break the valid low, which is this one. Let me make this crystal clear. For a low to be considered valid, the price needs to break the previous highs after forming the low. In our example, the price never actually broke the previous highs, which is this one, meaning the valid low is this one. So the price can do anything at this area, but as long as it remains above the valid low, this is still considered an uptrend. Now, let's take this a step further. If the price instead moves up and breaks the previous highs, this establishes a new high. In that case, the valid low shifts to the most recent low before the breakout. And for the trend to reverse, the price would now need to break this new valid low. Let's look at an example on a real chart. Here, we see the price forming higher highs and higher lows. And we can identify that the valid low is this one, because it broke the previous high afterward. Later, the price moves down and breaks this valid low. This break confirms a reversal since the price closed below the valid low. Keep in mind, it's crucial to wait for a candle to actually close below the valid low for it to be considered as a reversal. Once you understand how to identify a valid reversal, we can move on to the next step, entering at the first pullback. When we want to enter at the first pullback, we need to figure out where the pullback might form. This is important because pullbacks could form anywhere on the chart, and identifying the right area is key to timing your entry. From my experience, there's a specific area where the first pullback tends to form and bounce from, and it's called supply and demand levels. For those unfamiliar, supply and demand levels are areas where significant buyers or sellers have placed trades. The basic idea is that if the price retraces toward a supply or demand level, there's a high chance it will bounce from it, similar to how support and resistance work. So, if we can identify these levels on a chart, we can potentially predict where the first pullback will occur. The easiest way to identify supply and demand zones is by looking at the area right before a sharp price move. For example, if the price makes a sharp move upwards, the area before the rise is called a demand level. Similarly, if the price makes a sharp move downwards, the area right before that drop is called a supply level. Returning to our original example, you can spot this impulsive downwards move. To mark the supply zone, highlight the last candle before the impulsive move happened, which is this one. Use a rectangle tool to draw the zone from the candle's high to its low. This marked area becomes your supply zone. Once you've identified a supply zone, you can place a sell order at the bottom of the supply level, set your stop loss slightly above the supply level, and target a take profit level at 2 times the size of your stop loss. Alternatively, you can aim for the previous lows as your profit target. Now, let me clarify something. With this strategy, you're not entering the market at the current price. Instead, you're setting a limit order at your desired entry price, along with your stop loss and take profit levels. Once everything is set, just leave it alone and let the price do its thing. The trade only activates if the first pullback happens and the price hits your entry point. Like in this example, the price comes back, hits our sell entry, and bounces from the supply level, giving us a nice profit. But keep in mind, when using this strategy, there will be times when you've placed an order, but the price keeps moving without triggering your entry. And that's totally fine. Since no trade is triggered, you don't lose any money. The key here is to only take trades that perfectly aligns with our trading plan. If it doesn't, don't force it. Just stay patient and wait for the next opportunity. Let's look at another example. Again, the first step is to spot a trend reversal. And in this setup, we noticed the price was in a downtrend and then started moving upward. But look closely. On this particular move, price didn't give us any clear lower highs or lower lows to mark, as the drop happens in one straight swing. So, how can we tell if this upwards move counts as a reversal when there are no clear highs or lows to identify? This is where trend indicators come into play. While there are tons of options to choose from, I prefer the MACD because it's straightforward and reliable. So, let's apply it to our setup. Once the MACD is applied, we can use it to confirm whether this upwards move is a valid reversal. In this setup, we see that it crosses upwards at this point here. That's our signal that the reversal is valid and that we are now on an uptrend. So now, we can move on to the next step, which is entering at the first pullback. To do that, we need to identify a demand level in this setup. In this case, we can see that the impulsive move upwards started here. So the first candle before the impulsive move is our demand zone. The next step is to place a buy order at the highs of the demand level. Set your stop loss just below the demand level and your take profit targeting the most recent high. After that, we simply wait for the price to follow the trading plan. In this example, the price pulls back, triggers our buy entry, and then continues upward to hit our take profit. Now, even though this trade ended up being successful, you'll notice that the price experienced a slight drawdown and came very close to hitting our stop loss. But because we stuck to our initial plan and let the trade play out, the price eventually bounced, hitting our take profit. This shows why sticking to our initial trading plan is so important. Even with a slight drawdown, trusting the analysis and letting the trade play out can still lead to a win. That brings us to an important question. What if you can't identify obvious supply and demand levels on the chart? Well, there's another method that I use to find entries on pullbacks without using supply-demand levels, which is using Fibonacci retracement zones. Essentially, it's a tool that automatically highlights key levels based on Fibonacci numbers. As you can see, the tool generates multiple lines, and price has the potential to bounce off any of these levels. However, one specific level, the 61.8% level, also known as the golden zone, is where price most commonly pulls back into. This is why it's often the most reliable area to watch. Here's how I use it. First, if I've identified a potential first pullback scenario such as this, I'll draw the Fibonacci retracement tool by dragging it from the lows of the move to the highs. Then, at the 61.8% Fibonacci level, place a buy order with a stop loss set slightly below the entry. For the take profit, I either aim for the previous high or target an even higher level, as these setups often have the potential to run significantly. Once everything is set, just let the market play out and do its thing. And as you can see here, price just barely wicks into our entry, then bouncing off, making this a successful trade. Now here's the exciting part. The concept of the first pullback doesn't just work as a standalone strategy. You can also apply it to your existing trading strategies too. For example, one popular strategy that complements the first pullback concept is the breakout strategy. I won't dive too deep into it here, but the basic idea is this. Price consolidates within a range for a while, and when it finally breaks out of that range, it often makes a quick, sharp movement, leaving us little time to enter. And if you do decide to chase the breakout and enter anyways, you're going to have a bad risk-to-reward trade. So, what I like to do instead is wait for a first pullback to form before entering. Once the breakout occurs and the trend shows signs of slight exhaustion, I'll apply the Fibonacci tool. Drag it from the lows to the highs of the breakout move. Next, I place a buy order at the 61.8% level. Set a stop loss slightly below our entry and take profit at the previous highs. Now I'll simply let the price play out, and in this example, price retraced into the golden zone, hits our entry, and bounced off, hitting our take profit, making it a successful trade. Now, I cannot stress this enough, sometimes price may not even retest and just continues running. You will miss a few trade opportunities using this strategy, but missing a trade isn't the same as losing one. Personally, I'd rather stick to high win rate setups rather than entering at a bad price. So, learning techniques